This is the core of the unit. We are on financial management, so you have to think about how to manage your finances. And one of the things that we agreed were the functions of finance manager, and one of them was capital budgeting, financial decision, risk management, and such like things, right? And even portfolio management. Now, in financing decision, we say that this is where the finance manager looks for the sources of capital. He has to think about how to get money to finance the business. So that is financing decision. One of the things that we mentioned as sources of capital for the finance manager or for the business was ordinary shares. We say that you can issue the shares, right? You don't need to start writing, or maybe if you want to do it, you can do it at the back of your book. So ordinary shares. And we said how this one works. If a business does not have money, they can issue shares to the public, which is publicly traded. You can invite the public to come and buy through something called prospectus. You send an invitation for the public to come and buy, and maybe you want to run a project that costs maybe 2 million. So you need to ask yourself, how many shares do you want to issue and at what price to give you 2 million? So this is the value of shares or share capital. This is the value of share capital that you want to add to your business. So you're going to issue shares, and let's say that you are issuing maybe 2,000 shares. So definitely, if you are issuing 2,000 shares and you want 2 million, that means that each share will be worth 1,000. So that you have 1,000 shillings per share times the number of shares that you are looking for or you are issuing, you are going to have a total of 2 million. So that's one way of getting capital. That therefore means that we shall have additional number of shareholders so that the business will be owned by more people, and now the number of shareholders will be whatever was there originally plus the new 2,000. So it means that we shall have more shares or more shareholders. Alternatively, you can raise capital through debt financing or debentures. And we say that debentures are like loans. You also issue debenture certificates, and those guys will buy and give you loans, which you pay interest as a return. Now, when we are talking about return is what you're getting back as a result of your investment. If you are doing business, your return is the profit. So if I'm doing a business and I'm invested in that business, I put up some investment, my return is the profit. For those who are giving loan, their returns are the interest. That is the return, right? So I want you to look at this particular question. We shall read it together, or we shall write it down. I want to write down an illustration and say, BD Limited, at the top you can say illustration of financial proposal. Illustration for financial proposal. Then you write the question and say, BD Limited expects a return. BD Limited expects a return on investment, into bracket ROI. BD Limited expect a return on investment, which is written as ROI. ROI means a return on investment. BD Limited expect a return on investment, ROI, of 24% on proposed investment project. Of 24% on proposed investment projects. On proposed investment project. BD Limited expect a return on investment of 24% on proposed investment projects whose total cost is 5 million. 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 That is 24% on proposed investment projects whose total cost is 5 million. In order to finance this investment, 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 the company is considering two options. The company is considering two options. The company is considering two options. So I want you to understand what is important in this particular unit is that you understand exactly what the examiner is saying. Be able to translate. So we are saying that BD is limited. BD is just as a normal company or an individual person can also make an investment. BD Limited wants to invest somewhere. He has a proposed investment. He is making proposal. And he's now expecting a return of 24%. That is a return. That is a profit. So if I put my money somewhere, I'm expecting a profit of 24% on the investment that I put up. Therefore, if, for example, now we are being told that the cost of the project is 5 million, what do you think should be the amount of profit that you expect according to that statement? What is the amount of profit that you think he expects from this investment? The cost of investment is 5 million. What is the profit or return? In business, our returns, we call them profit. So, what is the profit that you think you expect in terms of figures? Thank you so much, Denti. Finally, you've logged in well. You've logged in well. Thank you. Now you can hear us, right? Can you confirm? I've written the question. And I've read the question, and I hope that you guys can be able to translate it and understand. 1.2 million. I was asking, thank you. I was asking, how much do you think the profit is? If you are investing 5 million and the rate of return is 24%, what is the expected profit? It is just 24% of 5 million. That is expected profit. Whenever you are doing business, you expect some return, right? So that is what you expect. Now, we have options. We are saying that for him to get the money or to invest in this business, there are two options. So in order to finance this investment, there are two options that he has to consider. Option number one, option number one, issue 5 million, issue 5 million ordinary shares at par value of 10 shillings each. At par value of 10 shillings, 10 each. At par value of 10 shillings, 10 each. He's looking for the money. The money that he's looking for should be 5 million. And there are options of getting this money. One of them is to get it through ordinary shares. He can also get the money to invest through loans. That is what we agreed, right? We say that when you want to invest, you can get money through loans, ordinary shares, preference shares. He has two options. The first one he can issue ordinary shares that can be worth 5 million. And exactly that is what he wanted. He wanted 5 million, so he can decide to go for ordinary shares fully. How many shares are these? How many shares do you think he's going to issue? Can somebody tell me? If I want to get 5 million, no, this one is 500, sorry. The number of shares is 500. So issue 500 ordinary shares at 10 shillings each. So if one share is 10 shillings, then the 500 will be, we have 500 times 10. BD Limited shall have gotten the 5 million that they are looking for. Is that true? That is the understanding. That is the understanding. There is an option of getting 5 million by giving out the shares, 500,000 shares, and each share is 10. So the total should be 5 million Kenya shillings if all the shares were issued. Are we together up to there? Are we together up to there? So that is an alternative way of getting money. You will get the amount. Let's look at option 2. So option 1 ended here, and this is now the implication. We were just trying to demonstrate that with this information is going to get 5 million, which is option number 1. Let's look at option 2. Option number 2 is can also get 5 million by doing what? Issue 250. Issue 250 ordinary shares at a par value of shillings 10 each, and obtain the balance through bank loan, through a bank loan, through a bank loan. It can also be debenture. They can say through bank loan or debenture. Through a bank loan or debenture at an interest rate of 15% per annum. Kindly copy that and let me know. Are we done? So we can raise the money through this option. So we are interested in getting 5 million, right? How can we get 5 million with option number 2? The first thing, we know that we are going to do 3 things. In option number 1, we were only issuing ordinary shares only. In option number 2, we are going to issue shares partially, and part of it we are going to get from loan. So we get money from ordinary shares, shareholders, and also from loan. So let's look at how that will work. So when we issue 250 ordinary shares, that is 250 ordinary shares at 10 shillings each, that will give us 250 times 10. How much are we going to collect? We are going to collect 2.5 million from ordinary shares. Is that okay? Does it make sense? The first option here was to get money purely from ordinary shares. In the second option, we can issue 250 ordinary shares, but each is 10 shillings. So how much are we going to get in terms of money? It is 250,000 times 10 shillings, which is going to give us 2.5 million purely from shares. And we need 5 million. We need 5 million. So how do we get the 5 million? We know that once we have gotten this, we still need a balance. The balance that we require is 5 billion. So you can say balance is equal to 5 million minus 2.5 million, where we are going to have a balance of 2.5 million, right? So it means that the other 2.5 million is what they are referring to. They are saying, and obtain the balance. So the balance we have seen, this is the balance that we want. How do we get the balance? Obtain the balance through a bank loan. So for us to get this balance of 2.5, we need to go for bank loan. We need to go for bank loan, and that bank loan should be 2.5. We need 2.5 bank loan. So we are going for a loan of 2.5, and the rate of interest on that loan is 15%. So we are saying that we need to go for 15% bank loan of Kenya shillings, 2.5 million. 2.5 million. That is what we are going for. We are going for 15% bank loan of 2.5 million. That is basically a statement that we have made. In both cases, listen, in both cases, we have gotten our 5 million. Option number 1, we were able to get 5 million. And if we go for option number 2, we can still get 5 million. The only difference is, in option number 2, we have taken loans as well. We have some shares together with loans. In option number 1, we only had shares purely. Now, we are told, continue writing there, down there. So in our instruction, we only had up to here. This one we have just done so that we can understand what we are doing. As you read the question, you should be able to interpret and analyze it. So in normal exam situation, you'll be given up to here. It is up to you to understand and interpret. So let's continue. They are saying that tax rate is given at 30%. Tax rate is given at 30%. The tax rate is given at 30%. Tax rate is 30%. Required, just write required. Determine the effect of the two financing options. Determine the effect of the two financing options on the earnings available to shareholders. Determine the effect of the two financing options So we have two options of financing. The first one you have seen, option 1 and 2, determine the effect of the two financing options on the earnings available to shareholders, and hence advise the company on the best financing option. Determine the effect of the two financing options on the earnings available to shareholders, and hence advise the company on the best financing options. If you are there, let me know so that we proceed. Pardon, I'm saying that determine the effect of the two financing. Determine the effect of the two financing options on the earnings available to shareholders, and hence advise the company on the best financing option. So we are told that there are two questions here. Number one, they are telling you determine the effect of the options. We have option number 1, which you have written, and then option number 2. Look at their effects on the earnings available to the shareholders. Now, I want you to understand, we have returns and then we have earnings. Are we together? Returns and earnings. What we had looked at earlier were returns. That is the profit rate of return. We are able to get our profit. Now, earnings are what shareholders, not the company now, the shareholders of the company, those who own the company, will get in return. Shareholders always get dividend in return. That is the earning. What they are earning as shareholders is dividend. The company gets profit. On that profit, the company is able to pay tax. The balance, they are able to divide amongst themselves in the form of dividend. So to the shareholders, what they expect here is dividend. So that dividend can also be in terms of earning per share. Dividend per share. Now let's look at this. Why are they saying that we need to look at the impact of the two options? Because they are not the same. The first option does not have loan, the second one has loan. They are trying to ask you, if we have loan, can it affect the way we are going to have our earnings as the shareholders? So let's have a solution. Solution. So we have option number 1. Option number 1. Then we have option 2. We have option number 1 and option number 2. Right? Then here, we start with getting our profit, operating profit. Which is also called earning before interest and tax. This one means earnings before interest and tax, EBIT. EBIT means earnings before interest and tax. Are we together? You can write somewhere at the top of the book. EBIT means earnings before interest and tax. That is EBIT. So it means that you need to get earnings before any deductions. It is also called operating profit. It is a total profit when you have only deducted the normal expenses. You have not deducted two things. You have not deducted interest and you have not deducted tax. But other expenses like salaries, administration expenses, transport, those things you have deducted. The only two things that are remaining that you have not deducted from this profit is the interest on loan, if you have the loan, and also the tax. And the way they come in order, it means that you first deduct interest and then you deduct tax. So you'll be deducting them in that order. You don't start by taxing before you remove the interest. You start with interest and then tax. Are we together? Now, so our earning before interest and tax, we are calculated. We say that if you invest 5 million and you expect the return to be 24%, then, or we can say that 24% of 5 million, so 24% of 5 million. What is our expected earning or return? Somebody to calculate for us. What are we getting? $1.2 billion. So this one, 1.2 billion, we shall get it. It is the profit. Whether you took loan or you finance it through ordinary, your investment was 5 million, so the profit does not change. Operating profit is not affected by the source of capital. Whether it is loan or you got it from your friend or your savings, that does not affect. So therefore, that profit cuts across the two of them. We want to compare the two, but the profit is the same for both of them. So we have profit here, 1.2 million. And then here, 1.2 million. Oh, we are together there. Now, we say that this one is profit before interest and tax. So we want to now remove interest first. We want to get net profit after tax. So you say less, the first one is interest. Less interest on loan. In option 1, did we have loans? Under option 1, did we have loan? Interest is only from the loans. Did we have loans in option number 1? We don't have loans. So you put dash because there was no loan there. In option 2, we had loans. So in option number 2, we have loan of how much? 15% of 2.5 million. How much is that? In our option number 2, you are able to calculate the amount of loan that we had to take from the bank. And the loan was 2.5. The rate was 2.5, was 15%. So we have to pay interest on that. And that is the interest that we have to deduct. So we are having 375,000. So what we are having here, we are going to have profit before tax. You call it profit before tax. It is before tax because already we have removed interest. It is only tax that is remaining. Or you call it EBT. Earning is the same as profit. So if you use the word earnings or the word profit, they are the same. So if the examiner use the word earnings or profit, it is basically the same. So this one is profit before tax, the same as EBT, that is earning before tax, or profit before tax. They mean the same thing. So our profit before tax here is going to be 1.2 because there was no interest here. Kindly get for me the figure. Get for me this figure. Then now we less tax. Tax we are told is at 30%. Tax is at 30%. So our figure on this other side is 825,000. Now get the tax 30% of each, 30% of this. Thirty percent of this. So how much? The first one. Then 60,000. So we less 360,000 from here. What about this one? 30%. So we have profit after tax, which we call PAT or profit after tax. Earnings after tax. Can also call it earnings after tax. What do you have? $247,500. 247,500. So get me the figures here. We're going to have 40. And this one. Is it like that? I'm not very sure. Confirm. I can also use my calculator. So we have 1.2 minus 360. Yes, 840. Then here we have 825 minus 240. That is where we are. Right? Now we have profit after tax. Now, normally when we get profit after tax, this profit after tax, we normally call it profit attributable to ordinary shareholders. Attributable means it is the amount that you can now go and divide amongst the ordinary shareholders. But in practice, in normal companies, they can get this profit and then they decide on two things. Part of it can be paid as dividend, part of it can be retained in the business to run the business. So they don't go home with everything. Therefore, whenever we have profit like this, the company has to decide, and we normally have something called dividend policy. They have to decide according to their policy, how much out of this profit should be given out as dividend and how much should be retained for running the business. Because huwezi kula kila kitu. Ukikula kila kitu, biashara haitagrow. So you have to save something. You pump or draw it back to the business to run the business, right? So in normal scenario, we have to ask ourselves, is there any amount that has been allocated as retained earnings so that we know how much will be paid out as dividend? In this case, the examiner is silent. The examiner has not told us that there is any amount that should be retained. The examiner has not told us that the business is going to retain anything. We are told that how much will be earning for the ordinary shareholders. Now, listen again. We have something called total earnings. Total earnings, the same as profit after tax. It is the same as earnings after tax or profit after tax. Are you getting? Your total earnings for the business like now, this one, is the same as profit after tax or earnings after tax. It has two components. It can be divided as dividend or retained earnings. It is composed of two. So if in exams, the examiner has given you the total earnings or earning after tax, and again, in additional information, the examiner has told you that part of it was paid as dividend, then you should know the percentage that remained as retained earnings. So the examiner will tell you, maybe dividend was 40%. 40% was dividend. That means that retained earnings is how many percent? If 40% was paid as dividend, how much did they retain from the earnings after tax? %60. Thank you so much. So we know that 60% was retained. I'm doing this because this knowledge will help you in this level and in advanced level. You will need that knowledge. So it is important that you know that in total earnings, or what we call profit attributable to ordinary shareholders, that total profit can be divided into two, and you need to know which one was paid and which one is not. Now, the one that has been given out as dividend, can be dividend per share. It means that let's say that we had total amount of profit was, like in this case, we have amount of total profit as 840, right? So let's say that 840 was the profit. Then it means that 40% of this is, calculate maybe 40% of this so that we know how much is paid as dividend. $366, right? So dividend will be 40% of this, which is 366. Now, this one is total dividend. It is the total dividend that the company has given out.
336.
Portion of dividend
336
wants to pay. This total dividend that the company wants to pay. Wamepata hii, wakagawana hii. This one is going to be paid amongst the shareholders. Now, assuming, Vincent, are you talking? Sorry. Assuming, now this one is the total dividend. Assuming that you know the number of shareholders. Like, for example, in the first option, we were told that we have how many shares? 500,000 shares, right? So if this is the profit that has been made, then this dividend, you can divide it amongst the number of shares so that you can know how much dividend per share for each share. So let's say that we have number of shares was, number of shares is 500,000. Dividend that has been declared, the declared dividend is 366. Then we call it dividend per share, DPS. dividend for each share is dividend per share will be DPS will be 366 over 500. How much is the dividend per share? How much is the dividend per share? $0.73. True. The same way we can get dividend per share, we can also get earning per share. Now, earning per share is the total earnings all over total number of shares. So we can also say, if this is the total number of shares that we are having, number of shares, then we have total earnings is 840. Then our earnings per share, which is EPS, this one means earning per share. EPS, earning per share, is equal to the total earnings, which is 480 all over 500. How much is it? Earning per share. 0.67. Is it that one? Earn it? 0.67. So there is something that I'm trying to derive here. We have seen earning per share, that is the total earnings, before you decide which one to go to dividend and which one to be retained. Which one to be dividend and which one to be retained. So which one is this? The first one. Make sure that we get the correct figures. Okay. So we are saying EPS is the earning per share. It is the total earnings all over total number of shares. That EPS has got two elements. Part of it is dividend per share, another one is retained earnings, also per share. So if you are talking about total, we have total earnings is made up of total dividends plus total retained earnings. If we are getting it per share, then you have total earning per share is equal to dividend per share and then the retained earnings per share. Now, what are we saying? I want you to understand that as an investor, your main aim when you are investing is the return. And to you, not as a company, to you, the return is what you're going to get in your share. When I've gone to any company like Safaricom and I bought shares from Safaricom, my worry is after buying the shares, at the end of the year, what will be my share able to give me? What will it give me? How much will I earn for each share? Not even the total number of shares that I have per share. That is what I look at. That is why, for those who are having, that is why, for those who have invested in SACCOs, they always, at the end of the year, we will see them asking, how much dividend did they declare? It is normally dividend per share. Alafu utasikia mwingine anasema 7%, 1%, 2%. That is the percentage for the shares that you have. So it is very, very important that you know that what is important as the return is the return on each share. And that return is the total earnings. It is the earning per share. So if the examiner asks you, like now they're asking you here, that determine the effect of two financing options on the earnings. Earnings. This is the earning. Determine the effect of two financing options on the earnings available to shareholders. It is the earning available for each share. So basically, he's asking you, can you tell us the earning per share that is going to the shareholders? Therefore, your comparison is in terms of EPS for each option. Let's now come back to what we're doing here so that you can understand. Now that you know what DPS means, you also know what EPS means. It is easier to move ahead. So this one was option 1. So we have our total earnings here. We have our total earnings here. We can now get our earnings per share. So we say earnings per share, which is now the same as EPS. That is what investor is interested in. So EPS is total earnings all over total shares. So we can say EPS is equal to total earnings all over total number of shares. Not shareholders, shares.